Well, good morning. I wanted to speak today a little bit about what's been going on in the news concerning mortgages, the concept and idea of uh, 50-year mortgages. Now, a couple few years ago, 2, 3 years ago, I was hearing from some of my mortgage lending partners about the possibility of a 40-year mortgage. Nothing really became of that, and now with uh, the new talk about affordability, which extrapolates out to all cost of living, not just as it pertains to mortgages, but how to make housing more affordable for more people. And hence, they're talking about a 50-year mortgage. And I don't know exactly how they're going to structure it. I'm familiar with all lending styles, types of products, from SBA various to various commercial type products and general residential, whether from an investment standpoint or luxury or general residential, primary, secondary home, etc. So, just going to talk a little bit. We're going to just look at some residential figures, um, just the basics, and try to unravel on what this might mean for you as a potential buyer. Now, over here, you can see our current national average at 6.34% on a 30-year fixed um, conventional loan. Now, that's just a national average today. Your particular rate could be lower, could be higher. I've seen it go both ways. And that's on an individual basis. There's no points paid figured into this to bring the rates down or anything like that. Just straight aggregate numbers. And looking at where our rates are today, we're on the lower end of where, over the last 52 weeks of tracking. And at 6.34%, you see our highest has been at 7.26 over the past year. And going back to 6.34, that's December of 22, January of 23 at 6.2, and then 6.58 in 23, 6.48 in March of 23, and it just started climbing from there. So this is the lowest it's been in about 18 months, 24 months, just depending on who you are, where you're at, for your 30-year fixed conventional. Now, of course, you can see rates are more favorable if you go with a 15-year mortgage, or if you're an FHA, or even a VA loan. I currently have a client, I got their approval letter yesterday. They're doing a VA rehab loan. If you're a veteran and you didn't know about a rehab loan for VA, those do exist, so contact your lender if you're looking to buy a home that doesn't meet the criteria for VA in a traditional sense, but something that you could, have a contractor come in and do a renovation on. So your lender will discuss the different criteria and about that style of loan. But I've got a client currently with a VA rehab loan. So looking through some figures, a common price point in my area is $400,000. Now, we do have homes that are less priced than that. I've sold a couple that were less than 150, or this year. I've sold some that were more than $1 million. So, so they exist all over the spectrum in Southwest Florida. You can get something for under 100,000, or you can spend more than 200 million. They all exist here. So, a common price point for the general, population of home buyers, 400,000, maybe a little less, maybe a little more. So we're just going to use 400 as a starting point. And with a 20% down, once again, staying on a traditional conventional loan, which is a 20% down program, borrowing $320,000. That's your loan amount. And on a 30-year loan, 6.34. I'm not going to figure any of the fees or anything in there. So we're figuring a $400,000 home value, a down payment of 80 grand. That's 20% of 400. with a loan amount of $320K, interest rate 6.34. First payment beginning January of 2026. So monthly payment just under $2,000. PMI is typically not required, and at 20% conventional. I didn't figure any taxes or insurance. So $2,000 a month. In your first year, you're paying 20 grand in interest with just under 3,700 in the principal. Another thing to keep into consideration is what we call the life cycle or market cycle, which typical ownership in Southwest Florida is 5 to 7 years. So, and going through it, 7 years, you get 1, 2, 3, 4, 5, 6, 7. So at the end of 7 years worth of positive payments, nothing late, nothing delinquent, nothing missed, you still owe $288,500 and change in principal balance. Okay? So in 7 years, using a normal appreciation rate for Southwest Florida at 4%, if you were to sell, yes, you're going to make a little bit of money. You're going to have a little bit of equity. That's after costs are taken into account for the transfer of the property when you sell it. So now moving that over to a 50-year loan, now I don't have any scheduling or anything to look at that using the same home value, down payment amount, loan amount, interest rate, just changing the terms, the only thing we're changing. And that brings us to $1,765 in a monthly payment. So it saves $250, a little less, $224 and change. So there is a little bit of savings there on the monthly, but here is the difference. You're still going to be spending 20 grand or so a year in interest, but you're going to owe 312. So at the end of year 7, you're going to owe 312 in your principal. So you might you might still have a little bit of equity there, maybe, aside from your costs when you sell your property. But if you try to go at, say, 5 years, owing 314. So if you go to sell, you're going to have less money to move on to something else. And in some cases, depending, if your rate comes in higher than that average, yeah, you could definitely be looking at something different. So in a different calculator, you're going to spend a little over $1 million. If you kept that home on a 50-year term and paid every payment for 50 years, you're going to spend $1 million for a $400,000 home. Total of $739,000 total in interest spent on the 50-year scale. But you can see, saving the $225 a month, it's just going to turn out to be less equity that you're going to make if you are in that 7-year home ownership cycle. I know people that move every 3.5 to 4.5 years. I know people that move every 8 to 10 years. I know people who've been in their home for 20, 30 plus years. So everybody's going to be different. But here in Southwest Florida, that seems to be a common occurrence, a 5 to 7 year life cycle of home ownership. For different reasons, it could be upsizing or downsizing because it could be a family or a couple that started a family, or they've got children leaving the home, or an elderly relative is moved in. You need a little bit more space to accommodate them. Maybe you need to get a property with an ensuite, maybe more of an apartment style, what we're starting to see now, and it's called multi-generational housing. Many different things. Me, in the past 5 years, I've upsized and downsized. Not because life changes, just because of, different situations within my own life. And I downsized too small, so I'm looking for another place now just to upsize just a little bit more. Still downsize from my original, where I was, but kind of in the middle of where I am now to where I downsized from. Because when I have company come over, it's a little tough. So going back to that 30-year scale, the end of 7 years, 273,000. So you have more equity if you go to sell. Now, a 15-year or a 10-year is definitely the way to go if you can afford the rate, which you see, we'll go back to here. Our 15 years, 584 currently. We'll plug that in here. And so that bumps up the payment to just under 2,700. Gets you out in 15. 7 years, you owe, nearly 205,000 in principal. So a lot more equity to capture in 7 years if you can, pay the 2,600 to 2,700 a month, plus your taxes and your insurance and any maintenance costs. What was it saying on the 10-year? 5,295. 5,295 on 10, keeping it 20% down. On 7 years, you're 114 grand, so you're paying a lot less interest. So you'd only be paying $92,000 in interest. Now, one thing that I thought was interesting when I put this into a interest-only style loan, so we're going to do 320 grand. Interest rate 6.34. Like I say, we're just going to keep it even. So $1,700 a month. That's not paying any principal, which was similar to this at $1,765. So you can see on a 50-year how little principal you're going to be paying every month. Starting out under 1,000 and then never breaking 1,400 on the year. So barely over $100 a month in principal. So yeah, you get the home ownership, you get the benefits of home ownership. You're just in the normal life cycle of a home ownership, 5 to 7 years. You're not making much of a dent in the principal. Because remember, we financed $320K, so that's $7,881 in principal that you paid in 7 years. That's not a lot. So it's up to you to discuss with your loan originator, your broker, your real estate agent on what programs that are out there that might be the best for you in your situation. Now, there are the option of paying in cash. If you've got the cash in the bank to pay cash, you could do that or put a larger amount down. And I've seen people do it. I've seen people put 40% down before. So, let's look at what a 30% down payment would look like. So that's coming out of pocket $120,000 plus your closing costs. and it is a little bit more palatable. You're down to 273 in principal owed on the 50. So, which that number is almost identical to 20% down on a 30. So you come through at a similar speed. But if you intend on keeping a property for 50 years and paying a 50-year note, you got to be cognizant of that, of this number here, $646,000 of interest. You're still paying, over $900,000 for a $400,000 house. And why is that? Why? Let's find a calculator and pull that up. Calculator, 320,000 times 6%. Well, let's do 6.34. $20,288. And where were we previously? $20,000. So the way amortization works is you're paying the interest on the entire principal balance each and every year. So the principal balance at time of signing the loan was $320,000, $20,000 in interest. And you pay, and we could do 6.34% against this number, and it's going to match that. So that's one of the things that I have been talking to people in the mortgage industry, in the different PACs in the state, and I've even spoken about it, to other persons that have, other legal influences of credit reform for consumers, especially where it pertains to mortgage interest amortization and how that is calculated and figured. And that's why you see these lenders and these banks record profits every year, is because they're making a ton of cash over on amortized loans. So, and also I'd like to see homeowners be able to take the same type of property deductions that, commercial property owners can take and investors can take. And that bill that the administration passed this year, for those persons that are purchasing investment properties, they get bonus depreciation, which exceeds what appreciation already existed, to try to spur further investment in the real estate sector. And also for all the businesses and manufacturing that the administration has been working hard to attract here, gives them further incentive to come into America, acquire the land, to build their facilities and get up and running before the taxation of real property starts. So it allows them to get built and get stabilized before that happens. So I understand why they included it, but largely in part, homeowners, they can deduct mortgage interest. Okay. Well, we're going to deduct 20 grand, this year, but that's going to be different per loan. If you're on a FHA loan, you're putting 3.5% down, and if FHA had where's that? I can't read today. 6.06. So if you're on FHA, loan term 30 years, you're paying $2,300. You get a more favorable rate, but you get less down payment, and you're paying more in interest per annum, even though you've got a better rate, but you've got less down payment, right? And there's different qualifiers for FHA. That's for lower income, struggling credit, things of that nature. If you've got over an 800 credit score and you make great money and you have very low DTI, you're not going to qualify for FHA. You'll qualify for a conventional because you're outside of the maximum criteria. Now, interest rates as pertaining to mortgages, I think need to change. The system is an old system. There's a lot of laws on our books as it pertains to finance, even division of property. For married couples. There's a whole slew of things that these policies were created a long time ago and are no longer applicable now. Used to be when I was born in the 70s, it was largely a cash-based society. There were credit cards, but they weren't as popular as they are today. And then coming, all the way forward to now, we started seeing a trend, in the 90s, early 2000s, where no matter where you're at, everybody's offering financing. Sell the payment, don't sell the price. And you hear that at the car dealerships. And that happens to anything else that you're financing, whether you're walking into a business to buy furniture, you're buying a car, a boat, any personal watercraft, four-wheeler, dirt bike, side-by-side, anything, that you would, consider making, taking out financing, making payments on. So our amortization, how it's structured, I think needs to change. I think it needs to be modified and be a little bit more consumer friendly. Because now that we're in a largely credit-based society where everything's done with debit cards and credit cards and financing, rent to own, things of that nature, we've kind of stretched society to the limit on how much payment they can take. And which is why the consumer credit card debt is the highest that it's ever been. So that might be a reform that our government could look at. It's like, okay, we've got, we need to make things easier for the people. And this is one way to do it, is to change up how amortization, how that algorithm for amortization is figured, rather than paying 100% of the loan principal the principal owed on the loan in interest every year, a smaller percentage. And, you can see how the scale goes here. Your payment is going to stay the same. The principal balance goes down, and the amount of interest, changes over 30 years. So they cross. So you're paying a lot of interest on the front end, it goes down towards the back end of the loan, and you're paying a little bit of principal on the front end, and it gets bigger as it goes up. So maybe a way to change that. No, I'd like some thoughts on this. If anybody's got any ideas, call the representatives in your state, Senate and House. Not the state level, but you could start there. And also, you definitely want to call the federal, because this is a national issue, not just a state. Now, the states can do certain provisions on lending, but they're very limited on what they can do because of the national side of things. So we want the banks to make money, but we want the population of this country to be able to afford payments. So like I said, with a credit-based society, we've kind of we've expanded credit payments on our people as far as we can go. So we've got to have relief, and what's that got to do is a restructuring of how credit is computated. And I don't see us going back to a cash-based society. But that's one of the things that I think could ease the pain on a lot of people, is changing how amortization is figured and paid over the life of a loan. I think it needs to be reduced. I really do. Paying the total principal interest each and every year, that's a big pill to swallow. We'll go back to the conventional structure. If you were to keep the home, you did a 20% down. Down payment, 30-year term, 6.34 on your interest rate. and you kept that house for 30 years, you're paying a total for a $400,000 house, you're paying $716,000 and change. Nearly $400,000 of that, almost double the value of the home, equal to, is in interest. So you're, over the course of 30 years, you're paying for it twice. Now, I'm for the banks making money. I really am. But making $400,000 off a $320,000 loan, I wouldn't classify that as predatory, but it doesn't make a lot of sense. It doesn't. Would the bank be able to stay in business if it was just a straight interest? So you saw we did that on a calculator, 320 grand. On the loan balance, 6.34% of that, it was 20,000 and change. Is that enough for the bank to make on the entire life of the loan? They're making 20 grand on a $320,000 loan. I don't know. So somewhere in between that and 400,000 is where we need to end up. Make it, I'm sure we can reach a point where it's palatable to the borrower and the lender. Because if you brought that interest down by 25%, so you're paying 75% of the amount, so that's going to take $5,000 a year off of your first year payment. That's quite a bit. That's quite a bit. That's $400 and change a month, bringing that down to about a $1,600 a month payment. And you're going to be paying a little bit harder on the principal, giving you more equity at the end of that life cycle. So I think our government can come up with something, but that's one of the things that need to change to keep things affordable. And I haven't heard anybody address that as changing the amortization calculation on how the interest is computed and paid. It needs a revision. It's old, like many other things on our books today in all different sectors of business and finance and social programs, that we need reforms across the board in many, many areas. And I think this one would be a very important one. I think it stands the chance to be a piece of key legislation for this administration or any upcoming administration that thinks that it'd be a good idea to take on. And you can talk to other real estate agents in the country, such as myself, broker owners, company owners, borrowers. They're not going to say the same thing. It's affordable. The monthly note is a problem, not just the note in itself, because everything else is expensive too. Every other point in cost of living, whether it's you got to buy a new dishwasher or a refrigerator, or you've got to have your vehicle fixed, repaired, which happens to all of us, whether it be wheel bearings or you got timing chain or gaskets or whatever it may be. It's tough. It is to afford life just because everything is expensive, not just the mortgages. And historically speaking, looking at our mortgages, back in 1981, they were 18% cash-based society, though, largely. And then as we get more credit-based, we see rates are coming down, but now they're getting back up to where we were back over here. And say in 2002, 2006, we're at 6.4. So yeah, we had a nice low level here. It was good. Inflation was more under control. We're getting back to it being under control, but here, when you have inflation going up, you have interest rates going up, it just really hit everybody from all sides. And bringing that back to where we're more in this cycle, where inflation is steady and measured, interest rates are palatable, Everybody's making money at the banks. Buyers can afford their homes, can afford the upkeep. We've got a lot of reversing, but I think for a long-term solution, helping the changing the way amortization is calculated, it's figured, calculated, and rolled out. I think we need to address that. Like I said, I'm not trying to take money away from the banks. I'm not trying to create a new social program where interest is subsidized by the federal government. That's not a solution. Just a recalculation of that. And also the Federal Reserve, the Fed rate, depending on the lender, the Fed rate is not the mortgage interest rate that the lender is going to, impose. Their rate is higher than the Fed rate. And I can do a whole nother video on what the Fed rate is and how it affects the mortgages. But I'm not liking the idea that the Fed prints the money, then us as a country borrow that from the Fed and pay interest on it, which is why the Fed rate is such a big issue, because we're paying interest on our money as a country. The Fed is a complete independent entity that prints our money. Why? I know that's been addressed by several administrations in the past 100 years. So that might be something that can come up to question. And we're paying so much interest right now on our money that the Federal Reserve is doing $3 billion worth of upgrades to their facilities. $3 billion. That's a lot. So a lot of different ideas, but this is my take on the mortgages. So I'd like to hear your thoughts. If you got any questions, reach out to me, Alan Printup, realtor, Southwest Florida, from Punta Gorda to Marco Island. I can advise you. I can connect you to any lender in the country. I've got lenders that work nationwide. I know real estate professionals all over the country. I've got clients all over the country. So I'm pretty well networked, and if you need help in your state, in your area, reach out to me. I can help. And if I don't have somebody directly in your area, or as a real estate professional, I can get somebody that is highly qualified referred to you. But I do have a lender that represents every town and every state in the United States and can get you taken care of from a mortgage lending standpoint. So that's a wrap for me on mortgages. Questions, comments, let me hear it. Alan Printup, your Southwest Florida realtor, from Punta Gorda to Marco Island. Have a great day.